let's see what I still remember from portfolio theory. This is portfolio theory, lecture 2, and we're back to chapter 5, and we have section 3, historical record. The section is written with a specific purpose. The specific purpose is to convince you must invest in stocks, right? Stocks are the best investment in the world, right?
Best vehicle.
Huh?
Best vehicle.
The best vehicle. Well, how do you know they're the best vehicle? That's because the textbook says so, right? You shouldn't always trust it or believe it. Alright, so number of things on this particular section. They use data set from 1926. That's where the data set comes from. That's where, or at least starts from. They use large cap stocks. They use some bonds. And the first simple lesson that they will tell you, for which, of course, we don't need, I don't need any research, is that stocks are riskier than bonds. Now, this is a pitiful result simply because we know that stocks are a whole lot riskier than bonds. That's fairly straightforward. But stocks are riskier than bonds, but it turns out that there is a little trick. How do we account for inflation? And that subject is not really well discussed in the textbook, right? It's just not really discussed. Of course, it's coming up in the next section, but for now, it's not. So, when you actually look at bonds, bonds during inflation are extremely risky. Extremely risky. Bonds during highly inflationary times are a whole lot riskier. Well, how do I know that?
Why?
Yeah, how? Right, why? How do I know that? And here is when you have inflation.
Because the recession follows, right?
No, wait a minute. Because there is inflation does not mean that recession follows.
There's growth.
The return is less.
Well, look guys, you cannot now get into macroeconomics. We can't get into macro. Alright? You can't just do this. Number one, if you have inflation, the discount rate rises. Why does the discount rate rise for bonds? Let's go to the next section on inflation. The next section on inflation simply says what? That nominal interest rate, big I, right, is equal I real. This is nominal plus the inflation rate. Correct? This simply means that if inflation rate rises from 1 to 6%, for example, and real rate is 2%, suddenly nominal rate rises from 3 all the way to 8. So when you discount a bond with 3%, it has one value, and when you discount the same bond with 8%, its value falls considerably. Sometimes 30%, sometimes 40%, sometimes it could fall easily 60 or 70% if the bond is very long term, 10 or 30-year bond.
But the reason it increases just to maintain the same purchasing power.
No, not to maintain the same purchasing power. Look, if you bought a bond in 1969 when interest rates were 3%, in 1970, 72, 74, 78, you continue to get 3%. This means you're running huge losses still get 1,000 of nominal, and you still get some miserable, pitiful 3%. Of course, this is a joke to the investor, but again, you have to understand what the reality is. So, number one, the discount rate rises, which is mathematically equivalent for bonds, that the price of the bond falls down. And the longer the maturity of the bond, the harder the fall. Now, if it's a 1-year bond, interest rates rise 5%. A 1-year bond will fall by 5%, the value, the principal, the market value. But if it's a 10-year bond, it could easily fall 50%, okay? In other words, a bond whose price is 1,000 is worth 500. That's the market value when you discount instead of at 3%, at 8%. And if you were investing in a 30-year bond, your portfolio is devastated. It could easily lose 60 or 70%. So 1,000 value bond for nominal that is earning 3% coupon, when interest rates are 3%, will be having market value of 1,000. And when interest rates rise to 8% and it's 30-year bond, its price will fall easily to around 300. So it will fall to 30%. You lose 2/3 of your money. Alright? And then there's that other little problem. So first of all, the discounting works heavily against you, especially for a long-term bond. Okay? But there's other little problem. Inflation eats or reduces value of principal when you get the principal. So 10 years later you get your 1,000, but 10 years later your 1,000 is worth maybe 500. In other words, inflation has eaten away half of the value of your bond. In other words, if prices doubled, the purchasing power of your principal that you get back is gone in half. Well, if you invested throughout the 70s, the stock market did not do much, meaning you lost fairly little over 10 years. Dow Jones was floating between 500 and 1,000 for 12, 13, 14 years. Let's say 1966 all the way to 1980 or all the way to 1982. You did not lose principal. Again, these are devastating losses. Dow was 1,000, Dow was 1,000. You got a nominal return of 0%, maybe minus 5%. On a 14-year of inflation where the prices increased 3 or 4 times, that's a pretty bad outcome. You lost 70-75% of your portfolio, of the value of your portfolio due to the loss of purchasing power. But with bonds, it's even worse. You started out with 1,000 and your portfolio's been steadily going down as interest rates have been creeping up because inflation has been going up. So if you had invested in a portfolio of bonds, it's even worse. So during highly inflationary times, one thing is sure: stocks underperform, but bonds are way worse. All right. So the way the textbook says it, it's highly manipulative. Of course, we can figure out the statistical technique which distorts this, because what inflation happens throughout some inflationary periods. You have periods for 10-15 years of high inflation, periods of 10-15 years of low inflation. When you get to just average out the whole thing, the picture looks nice, but you can't average out the whole thing. Well, you can't just average out you're 20 years old, let's average out your next 40 years. I mean, you start investing now in a highly inflationary environment, you use the best years of your life from 25 to 45 years age when you earn a lot and all the good stuff, and you end up at the age of 45 with 2/3 of your portfolio wiped out due to very high inflation. You can't just average out. Because then you can't begin at 45 and start catching up everything you've lost for the previous 20 years. Alright, so the averaging process provides extraordinary level of distortions. Alright, let's see what else is there. Here's another one which I'm looking at, page 137 on my textbook. There's a nice little box which says the risk premium and growth of wealth. Right at the very end they say, in both periods there was a considerable risk premium to be earned from the risky investment. So, what they really tell you is, okay, here is a period, and from this particular period there is plenty of risk premium to earn. But the period starts from 1993. And from 1993, you had a booming stock market. Alright? You have such a booming stock market where you had excessive returns. Well, what do you mean excessive returns? Well, you could have 10-year periods, like 1970s, when the stock market is completely underperforming. The stock market is total disaster. And of course, you can have 10 good years when the stock market is way, way better. You know, as the Bible says, 7 good years are followed by 7 bad years. Well, it may be natural, you know, in nature to be 7 years, but in stock markets it's sometimes 10, it's sometimes 15. So, you cherry pick a nice period, let's say 1990 to 2000. Of course the results will be beautiful, right? Because the stock market worked great. Well, let's try it the other way. Today is November 3, 2008. Suppose you invested in November 3, 1998, 10 years ago. And you invested in the greatest stock market in the world, right? The New York stock market, Dow Jones. What's going to be the outcome? Bad, really bad. I mean, how much was Dow Jones in 1998? Like 9,000, right? How much is Dow Jones today? 8,000. So you invest for the long term, 10 long years, and you don't get return, meaning your nominal return from 9,000 to 8,000 is actually minus 10%. You lost 10%, waiting for all of these times. And 1998 gasoline in the US was cheap. I was filling up my gas tank for $1. Now you're filling for $3, meaning inflation went up roughly 200%. Of course, you don't ever trust government statistics, because government statistics are manipulated, alright? I mean, they still say it in the United States like 2 or 3% inflation. Of course, you understand by now that no common sense American person ever believes or trusts inflation statistics anymore, right? 3, 5, 8 years ago, yeah. But now everybody understands that inflation statistics are a total joke, maybe except for economists, right? Alright.
When you invest 10 years ago, you won't get a dividend.
Yes, the dividends for Dow Jones or most of those is pitiful. It's
nothing.
It's nothing. All right, let's say it's 1.5% annual dividend yield. So yes, you may have gotten a cumulative dividend of 10%. So it was 9,000. You're back at 9,000. 10 years of your life are gone. You've been pouring in money and zero return. Again, what is the point? I'm trying to make a major point. This is extremely manipulative. I can always pick the period, and the period will tell you, let me read, there was a considerable risk premium to be earned. Well, if you pick from 98 to 2008, there was plenty of money to lose. Alright? Actually, for this period, you did not earn any risk premium. Moreover, you did not earn any money at all. Moreover, you actually even lost money. The risk premium was very negative, okay? So, you have to understand that there are good periods, there are bad periods. I mean, if you invested in 1929, of course, that's the peak of the previous bubble, of the bubble of the 20s. The stock market will come back in 1945 or 46. So for 25 years, you earn nothing. Zero. You earn no risk premium. 25 years is a very, very, very long term. And stocks in the long term don't always provide good returns. They provide good returns only in the textbook and only when a financial advisor advises you to put your money in the stock market. Okay? Is that fair? So, you have two really good examples. One is from 1929 all the way to 45 or 46. You earn nothing. Now, you can go back to 97, because the stock market is right where 96, 97 it was now. And this means for the last 13 years you earned nothing. You got no compensation whatsoever for your risk, and you certainly lost a lot of money, at least half of your money, due to loss of purchasing power, which we call inflation. In other words, inflation risk was totally uncompensated. Pure loss. Alright? Well, again, for Wall Street, it's a different story altogether. Who gains when you lose in your investments, right? Who gains the inflation? You know, who collects the inflation tax? A whole different story. Is this good enough so far? Is it very clear? Question? No question. So, that was very nice. Of course, they will give you very nice, good formulas to convince you that everything is fine. Okay. Here, so that's very extremely manipulative. The extremely manipulative part in this whole thing is that in the world of investing, there are bonds and there are stocks. Well, where are the commodities? Where are the commodities? The answer is not in this textbook. So, commodities, you have to understand, are a legitimate investment. Oil, as it is today, oil, as it has been over the last 6 or 7 years, is one of the best investments ever. Even now, oil prices collapsed 50%, right, over the last 4 months, from $145 all the way to $69 was this morning. Even that doesn't mean that oil was a bad investment. Why? Early 2001, oil was roughly $10.
Investing in commodities is lucrative, right?
Is what? That's what I'm explaining now. Not necessarily. Investing in commodities is as lucrative as in stocks. Investing in commodities has good times to invest in stocks. In commodities and bad times. If you invested in commodities from 1980 or 1982 and held all the way for 20 years, long-term commodities, again, you will be devastated. The prices of commodities fell many times over. The price of oil fell from $45 all the way down to $10 for the 20-year period from 1980 to 2000. So, the 80s and 90s were a total disaster for commodities. So, it was not lucrative for this period. That's extremely important. But if you pick the period from 2000 all the way to 2008, oil prices have gone up roughly 6-7 times, and Dow Jones has gone down from 2000 up until now 30-40%. It's like, what is it, 12-13,000? Now it's 8,000. So Dow Jones has lost 40%. Oil has gone up roughly 6-7 times. In other words, if you invested in oil instead of Dow Jones, you will have made 10 times more money. So right now and over the last 8 years, commodities are infinitely better investment than stocks. So commodities don't exist for the textbook, but in the real world, you should know when the time is good to invest in stocks, and you should know when the time is good to invest in commodities. And the one connection which is fairly strong is that whenever bonds perform well, commodities don't perform well. and the opposite. In other words, in highly inflationary times, commodities perform extremely well and bonds get crushed. And in this inflationary environment, usually bonds perform well and commodities don't. So, this is the most important relationship that you should remember. In other words, the driver turns out to be inflation, not the growth piece. Question?
What do we know invested stocks or commodities?
Huh?
The time to invest in stocks. How do we know the time to invest in stocks?
Well, that's what we will do for the rest of the semester. So the question, how do we know it's good now to invest in commodities, and how do we know it's good now to invest in stocks, right? Well, the answer is, this is what we'll be doing over the next 10 weeks. Part of this is called, number one, cyclical analysis. You run a standard cyclical analysis or non-standard, and you figure things out. Number one. Number two, you follow closely monetary policy. Based on what monetary policy you see the central bank is implementing, whether the monetary policy is highly inflationary or disinflationary. In other words, you have to figure out what is the inflationary environment. Right now, as of 2008, the Federal Reserve is highly, extremely inflationary. Since the credit crunch began, and especially over the last 4 or 5 months during the bailouts and everything else, the Federal Reserve has ballooned its balance sheet 100%. Usually it will take 10 years for the Federal Reserve to double its balance sheet, which means that the balance sheet represents the liability of the balance sheet of the Federal Reserve. The Reserve represents the monetary base. And broad money supply equals monetary base times multiplier. Multiplier is fairly stable over the years or even over the decades. So, if you double the monetary base in 10 years, money supply will roughly double in 10 years, alright? Now they've doubled the monetary base literally in 3, 4, 5 months since the big bailouts began. Well, you double the the monetary base. Sooner or later, the broad money supply will react. And whether it reacts in 3 months or 3 years is irrelevant. Whenever the reaction comes, you will get hurt real bad. So, in this highly inflationary environment, you'd better stick with commodities, and you'd better stay out of bonds for sure, and also you'd be smart to stay out of stocks too. So how do we know? You look at the, number one, monetary policy. You look at the overall global inflationary environment. You look at overall economic growth. You provide what is called, and let's put this in here, macroeconomic investment analysis. In other words, how you know by doing big picture macro analysis, and this is what this textbook will not teach you. Alright? So this is what they want to teach you is how to get buried into stock analysis. Quick ratio, liquidity ratio, they try to get you buried into ratio analysis, where you look at the balance sheet and start looking into, and rather than, look at the big world and look around and see what's out there, meaning see what's the big picture, what's the global macro environment, see what's going on with the economy. Instead, you get buried into a balance sheet, an income statement, you do a whole bunch of ratios, and then try to figure if it's good or not good enough. And the idea is, you miss the big picture. And the big picture is infinitely more important. In other words, the macro picture for investing is infinitely more important than the micro picture of investing. And if you have been, for your exam, listening to Peter Schiff, the one thing that you should have actually picked up is that first and foremost, his investment strategy is based on macro analysis and macro fundamentals. He comes up, hey, what's going on with inflationary environment and expecting commodities to rise? What's going on with a whole bunch of other things like growth, inflation, etc., etc. And he's not getting buried into trying to pick this stock over that stock, all right? So that's one of the big lessons to learn. Now, the other thing that the textbook is saying is firm size. And what they're saying is, if the company was small, you will be getting a little higher risk premium. Actually, that could be potentially true, but the risk premium first wasn't that much. Now, firm size, you have to understand, I know a whole bunch of professors in finance. Professors in finance and academics and research is preoccupied with firm size for a good reason. And the good reason is that you always get in a database the number of outstanding shares. And you always get in the database the price of the stock. So, in the database, you can always get, based on market share, outstanding shares and the stock price, you get the so-called market cap. Market cap stands short for market capitalization. And this is the market value of the company. Because it's extremely easy to get in databases, the next thing you do is you get the returns of a bunch of companies and you run a regression based on the market cap, right? It's fairly easy for an undergrad student to do. So what professors do is they run the next regression and publish their next article, all right? It is all about publishing articles in journals. So what you have to understand is this whole preoccupation which they try to convince you is so important. The answer is yes, it is extremely important for professors in finance to publish in journals in order to secure a cushy teaching job at a university, right? I'm also one of those too. But that's the preoccupation. But this is not as important in the real world. Yes, it has some importance, but big picture is very important. But they spend enormous amount of time. Hundreds, if not thousands of articles run ever more sophisticated regressions with all sorts of adjustments so that they can correlate that, oh, market capitalization can explain a little extra premium, and then they run a little explanation. Sure, big companies are run by smarter, more stable, blah, 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 and small companies are riskier. So, here is the theory. Question?
Can you say that general investing in commodities is better than bonds and stock?
Well, this is
from the historical
right. This is exactly what I have been explaining over the last 5 or 10 minutes. Generally, no. Generally, there can never, ever possibly be one investment that is better than the other. Like there was over the last 10 years or 5 years in the United States. Like every single American will tell you that real estate is the best investment ever devised by God, whichever, God you have, right? So, they will tell you that God made real estate the best investment in the world, and it made it so that Americans can be or become rich based on that investment. Well, it turns out that as soon as too many people figure out that this is the best investment, they begin to invest in it. They drive the price sky high, meaning price begins to rise above fundamentals, and the end result is that eventually the price collapses back, and those who entered the investment late will certainly sustained huge losses. So the answer is neither commodities are the better investment, nor real estate, nor stocks, nor bonds.
So why the propaganda is hiding commodities? Like they're focusing more on bonds and stocks.
Yes, that's why I explained this 3 lectures ago. I'll repeat it for you again. Wall Street manufactures stocks. The propaganda from GM is that you must buy GM cars. All right? The Wall Street produces stocks. It's a piece of paper, they put a little stamp, and they say, stocks, invest in it, and they sell it. So they take your money and they give you a piece of paper. So Wall Street sells those things which it can manufacture. And it can manufacture stocks real cheap. The cost of manufacturing stock is next to nothing, all right? It's just a piece of paper. Just like manufacturing dollar bills costs 20 cents to produce a $100 bill or a $20 bill. So it is very profitable business to produce or manufacture for 20 cents a $20 bill, and you get 100 times return on your investment, on your manufacturing. I mean, if you can manufacture a stock for 2 cents and sell it for $50, and this is exactly what Wall Street does, then they will be selling you stocks, okay? Now, why would also the government endorse such thing? Well, because government is the biggest seller in the world of bonds. Of course, what does it mean selling bonds? It means they give you a piece of paper, they promise you to pay you sometime later, maybe a little bit more, and in the course of doing that, they take your money. You know, you give them $10,000, they give you 10 bonds. And usually, 10 years later, you find out, as happens most of the times, that your money that you gave them, you know, is more than what you got back with interest once you factor in inflation. In other words, quite often in the real world, the return on bonds is negative. Of course, they say, well, you got a 4% return and inflation is 2%. But inflation is not 2%. Reported inflation is 2%. You're told that it's 2%, but real inflation is more like 5 or 10, all right? So, there are good times to invest in stocks and bonds or real estate, and there are bad times. And some periods favor some investments more, and other periods favor other investments. But there is never one best investment for all times. If there was, smart people will have figured it out hundreds of years ago. You got to understand. They were stocks and stock ownership shares traded in ancient Rome 2,000 years ago. Stock market of Great Britain's been functioning for 400 or 500 years. People have invested in real estate for thousands of years. You have 1,000-year records on real estate prices in Rome. Ever since Rome was established sometime 500 years BC, to up until Rome fell 500 years after BC, right? So, you had 1,000 years of record on real estate. Well, what's one of the lessons we can learn from 1,000 years is that real estate prices can fall down to 0. Vandals can wiped out Rome, return is 100% lost, right? You're told you can never lose your money in real estate. Well, now you find out you can lose a lot of money in real estate. But if you look at historical record, you can actually find out that, you know, as the barbarians swipe through, you can lose not most of your money, you can lose all of your money, all right? So, there is no such thing as safe investment, and again, it's a whole different story altogether. Now, let's get back to some other stuff. All right, we have, I covered most of the 5-4, which is inflation. 4. Inflation, I covered the Fisher equation. In other words, nominal interest rates will typically adjust upward to incorporate inflationary expectations. The correct statement is not the inflation rate. That's not the correct statement. The correct statement is the expected future inflation. Expected future. So, expected inflation is actually however you designate inflation. So, that's very important. In other words, what bonds and in general returns incorporate is not the past inflation rate. It is the expected future inflation rate. Okay, so that's very important. The other important thing is to consider is that while CPI has been for a few decades fairly reliable, over the last 2 decades the US government has been heavily manipulated CPI for its own reasons. There are institutional reasons, and CPI has become extremely unreliable. Of course, in Bulgaria, people are a lot more cynical. No Bulgarian would ever trust the government when the government says 7%. Bulgarians know that inflation is 20%. When the government reported 10%, Bulgarians knew it was roughly 30-35%. So most Bulgarians will surely know that real inflation is at least 2 or 3 times higher. But it's interesting that over the last 3, 4, 5 years, even the US government has lost its own credibility, and even American people don't trust the inflation numbers anymore. Now, the only ones that trust inflation numbers today in America are the American president, the chief of the Federal Reserve, a lot of economists, and a lot of Wall Street strategists and advisors.
If the inflation rate is, the government given inflation rate is not accurate, why isn't there any other organizations that give you a more accurate?
Well, you start doing that and you begin to feel the heat. You know what's to feel the heat? They put extraordinary pressure on you. You're standing up against the greatest government in the world. They'll shut you down. It's very easy. They'll raid your offices and say, oh, you can't do it. Well, first they're going to give you a nice phone call and say, look, you can't do what you're doing. It's not nice, all right? Stop doing what you're doing, you know. Then they say, keep in mind, you're actually violating law 371, whatever. So, you may be actually in deep trouble for doing what you're doing. So it's called cease and desist.
Yes.
All right. Then they call up their buddy, who is of course a judge, and the judge will send an order. Cease and desist. Right? You know what it is? It means you gotta stop doing what you're doing because it's illegal and it hurts the national interest. All right.
Well, at least they warned you.
Huh?
At least they
warned you, right? At least they warned you. Anyway, so yes, that could happen. In Bulgaria, it actually happens, and a lot of people actually trust the alternative inflation numbers, which come out of the labor unions. Labor union computes its own number. It's about 2 or 3 times higher, and people actually trust a lot more that number because that number has less bias. In other words, the labor unions are trying to get a more realistic inflation number in order to push hard for the compensation of workers. They say, hey, inflation was 30%. We want you to raise 30% wages, at least to keep up with inflation. All right? So these are institutional issues and problem. All right, the next one is 5, section 5, which is the so-called asset allocation choice. Now, here's the one piece which I like a lot, which is probably the best lesson that people learn from this textbook, but I've been explaining it anyway today, is that, let me try to see, is the most fundamental decision of investing is the allocation of your assets. In other words, asset allocation simply means, as we started from the first lecture, how much you put in stocks, how much you put in bonds, how much you put in real estate, how much you put in commodities, and how much you put in currencies. And here is a beautiful statistic. I'm reading page 144, coming out of the Vanguard Group's John Bogle. John Bogle is a legend in the world of investment. And he says, that decision of asset allocation has been shown to account for an astonishing 95% of differences in total returns achieved by institutional investors. This sentence needs a lot of explanation to understand. In other words, this fund used 100% bonds and 0% of all the others, and this fund used stocks. When you compare the returns, 95% of the difference is explained entirely by the asset allocation. This means that the choice of asset allocation predetermines already 95% of your returns. Like, you chose to invest stocks, you pretty much, over the last 10 years, you're pretty much doomed to lose money. On the other hand, you chose to invest in commodities. Even the dumbest, most stupid investor who's totally incompetent and was throwing darts at commodities, could be oil, could be of course gold, could be corn, wheat, uranium, any random commodity that you can pick, copper, zinc, everything, you would have gotten 500–600% returns, all right? So, even the worst possible choice of commodities would have still given you extraordinary returns, all right? And no matter how well you were picking stocks, you would have not made any decent return. So, the experience from the last 10 years shows you basically that the lesson is that the asset allocation was the only correct decision that you have to make right. Once you make it right, you could be a terrible investor and you would still come out great, okay? And the opposite is true. You made the wrong asset allocation choice, meaning you followed the advice of Wall Street advisors, you invested in stocks and bonds, and even if you had the best investment advisor who was picking the very best bonds for you, you would be still totally devastated. Even the very best of the best of the best still will do terribly in the last 10 years. And this is what it means. 95% is already predetermined by the asset allocation, and the other 5 we can attribute to extraordinary skill or stupidity. In other words, asset allocation is extremely important, and no matter how skillful you are, it will barely allow for 5% of your return, alright?
In other words, it means making balance between risky and high risk. In other words,
how risky?
Asset allocation.
Okay.
It means making balance between high risky investments and low risky investments. Is it making balance?
Okay, well, again,
Can you say this?
I never mentioned risky or riskless.
Then why do you make the asset allocation? Isn't it
Because this is what Wall Street is telling. This is what the theory is, all right? We create a nice theory on which we crank regressions. As you see, regressions take care of jobs, of professors. You understand, this is shockingly simple. If you can crank out a regression, you make a correlation between one variable and another variable, you write a paper and you publish. I never mentioned risky and safe assets, alright? A riskless asset. I never did. Did I ever mention it today? How did you came up with it? You came up because it's coming in the textbook. Right, this is what I've been explaining so far. The book is highly manipulative in this particular sense. Here is the next one. Let's try and really indulge it. You invest in safe stuff. What will be considered safe? Bonds. Well, bonds are certainly not safe. T-bills, yes, T-bills. What is safe is only the principal. you still bear...
Because the risk of inflation.
Yes, you still bear the full risk of inflation. Inflation risk never goes away. Inflation risk is always there, no matter what you do. And even if, as the textbook says, you get an inflation secure, like inflation compensation, the so-called TIPS, the measurement of inflation will, still run that particular risk, because the government, when the inflation was 10%, the government said 3% or 2.5%. I mean, you gotta understand, a bureaucrat decides what inflation is, even though you're told that you have an army of statisticians and thousands of people who actually collect the data. Sure, that's true. You have an army of statisticians. That's, of course, also true. But at the end of the day, when inflation turns out to be 8%, 8% cannot be reported. 8% official inflation today will be a total disaster. The U.S. financial and banking system will totally collapse. Under no circumstances 8% is reportable. So they massage, they provide, there are 4 fundamental techniques, and to get back down to 4% inflation. 4% inflation, politicians and Wall Street can swallow. Alright? Is that fairly clear? So, now let's get back to your risky and risk-free investment. Now, here's another beautiful thing. I love this part in 145. The conclusion is that money market mutual funds are considered to be the safe investment. It is safe, it's all the good stuff, everything's great, you just invest in those. Well, what is money market mutual fund made of? What are the key components of a money market mutual fund?
Stocks, bonds.
No. Stocks, bonds, no. What is a money market mutual fund?
Debt, loans.
What kind of loan? Number 1, CD, which stands for Certificate of Deposit. This is debt manufactured by commercial banks and sold by commercial banks. So, if you buy money market mutual funds, you are financing banks, alright? You're providing short-term debt to the bank, which the bank, of course, uses to re-lend at a lot higher price, alright? Isn't that nice? It serves really well commercial banks. What else is out there as a component?
Repos.
Repos, yes, repos. Repos are usually issued by either corporations or commercial banks. Let's call them financial institutions, because there are other financial institutions. And there is one other important component called commercial paper. And again, what is commercial paper? This is a security issued by a non-bank or non-financial institution, some business, to finance its short-term operations. So, commercial paper usually is, again, yet another debt. Well, credit crisis came. It did come eventually. What's the lesson learned?
It's not safe.
Money market mutual funds are not safe, but you're told it is. Why? It's still the same, sells the same thing. Paper manufactured by Wall Street, which finances big business. Commercial paper is usually issued only by major corporations, at least unbacked or unsecured. So, again, big corporations and banks. Once again, it's the same old story. We know the lesson now that money market mutual funds are far from safe. We also know now that they turn out to be not as liquid as we are told that they are. We now find out that the government, actually the Fed and the government, had to inject hundreds of billions of dollars into these money market mutual funds to support them. But what does this injection of hundreds of billions of dollars to support money market mutual funds mean? It simply means that, again, the risk did not evaporate. The government transformed one risk into another. It took a liquidity risk into a credit risk. In other words, commercial paper had some credit risky problems, right? And what it did is, by injecting the money, it created the money out of nothing. In other words, it created inflation. So, it transformed one type of risk, or two different types of risk, the risk of default and the risk of liquidity, into inflation risk. So, risks actually transform. So, this is one of the super simple things which Peter Schiff is hammering on. The economy, as it is, has certain shape. Right now, it's bad. Corporations are in trouble. The government cannot solve it. All it can do is create more credit, and with it, actually transform one type of problem into a different type of problem. When governments transform problems, the general rule is that the new problem is always worse than the previous one. Alright? Because the transformation in a non-market manner, in a non-competitive manner, always evolves or involves inefficiencies. Alright?
So government's intervention, government's intervention is never a good thing.
Yes, government intervention, the general rule is always makes bad things worse. Now, here is the key to understand. When government intervenes, it makes things better today, but tomorrow they will be worse. In other words, when they created today and injected $100 billion, today is better because the money market mutual fund can pay you all the principal and some return. But tomorrow, in other words, when the government solves one problem, actually governments never solve a problem. Solving a problem means they have to actually produce something, actually do something, create something. What they do is postpone today's problem for a later time when the problem is bigger. What this credit crisis now represents, effectively, is pushing problems from 1992 was pushed over to 94, from 94 was pushed to 97. So every time there was a problem, the government solved it by pushing it for a later time and making it, in the course of doing that, bigger. Well, at one point, the problems become so big that it overwhelms the government ability to push it even further out. All right?
Sir, also Schiff says in his articles that when the government intend to make an intervention to fix something, to solve a problem, they make many other problems.
Yes. This is called the law of unintended consequences. The law of unintended consequences means you can't just intervene in the market and solve one problem without causing 3 or 30 other problems on the way.
They might not show at the moment, but in the future.
Yes, of course, that's always true. They don't show up right now, but they are there. They are created, all right? They will surface later on. So, let's see, we have about 10 more minutes. Let's see what we have now. All right, so we have now your thing, the so-called complete portfolio. And complete portfolio is the total portfolio that you have. Complete portfolio will have a risky portion.
And risky.
Yes, risky, and the other part is risk-free. The risky portion will include assets with some variation in returns, in other words, assets that possess risk. And the risk-free will have no variation of return, presumably will be risk-free. So, what you're told is now the so-called basic asset the basic asset allocation is the percentage that you invest in risky assets versus the percentage that you invest in risk-free. So if risky assets is X, the risk-free will be 1 minus X. So the basic allocation problem is simply X 1 minus X, where X is between 0 and 1. Now, what needs a little explanation for understanding is the risky part. Risky part is effectively a risky portfolio. So, you take one stock, it's risky. You take two stocks, you combine them, they represent a risky portfolio. Alright? So, what the risky portfolio represents is a combination of risky, and of course they're stocks, right? No oil in there. So, risky means that you create a specific portfolio of risky, and the asset allocation problem is how to split it with risk-free. So that's number one. Number two is that...
Sir?
Yeah.
In case of risk-free assets, do they, when we have a bad outcome from risky assets, do they compensate for this?
They don't compensate. They make losses less.
The presence of risk-free.
Okay, well, that's what I'm explaining. You're asking 3 steps ahead. You're asking questions which I'm just about to explain to you. Alright? So all you're doing is disrupting. Let's see. You get risk-free return, maybe 3%. Risk-free return, maybe 3%. You're getting then your expected, that's the key. Your expected is, let's say, 13. So the risk premium which I'm drawing the picture on here is actually of 10%. So if you invest all in the risk-free, you will get 3 for sure. If you invest all here, you will get an expected of 13. So you could invest maybe 50-50, and the expected rate will be between 3 and 13, which is 8, okay? So, what you can do is, for any percentage, where here the allocation is 0, 1, here the allocation is 1, 0, or 0, 100%, here the allocation is 100%, 0. Here the allocation is 50%, 50%. Okay? And if you chose this allocation, will be 0, 50, will be 75, 25 is the ratio between the two of them. So, at any point in time, you get particular risk and particular return. It is pure math. It is simple, elementary mathematical derivation that as you increase the share or percentage of the risky assets, all you do is increase also linearly the risk premium. So for 1 unit of risk, you get 1 unit of risk, of return. 2 units of risk, 2 units of return. This is elementary math. In other words, what this is saying is that this is a straight line. It's just pure math, okay? It's the textbook shows a little bit. So that's number one. And now I'm beginning to answer your question. Suppose that you actually did not get 13, but the return was something like this. So if return was instead of 13, 10, okay? If you invested here with this ratio, you would still be getting 3%. You invested 100%, you would still be getting 10%. And you will be getting in between. So, if you invested 50-50 instead of 100%, you would have gotten here, that much of a deviation from the expected risk premium, and in 50-50 you will get half that deviation.
Reduces your losses.
So if you actually realized a loss, the market made minus 2%, then if you invested 100% in the market, you will get minus 2%. This is the zero here. However, if you invested 80% in the market and zero in the bonds, you will be still getting zero return. But if you invested 50-50, you will be probably getting around 1.5%. All right? So when the outcome is bad, the risk-free, the more you invested in the risk-free, the less of a problem. It mitigates the overall loss. So, I hope this answers your question. Let's see what else we have. Let's see what else. Oh, that's my favorite that I was telling you. All the money market instruments are virtually immune to interest rate risk. Yeah, that's true, but it doesn't mean that they are immune from risk. Let's see what else we have. Straight line. Okay, this ratio here, represented by this angle. So this ratio is simply the compensation for risk. If you take that much risk, you get that kind of compensation for risk. If you get twice the risk, you get twice the compensation for risk. So when you divide the compensation of risk for the risk that you take, you get a variable. Of course, that variable is represented by the angle, so the tangency of the angle, and it has a special name, and it's called reward to variability. So reward to variability is the same. Reward stands for risk, and variability stands for, reward stands for return, and variability stands for risk. So it is simply represents the return to risk or return for risk ratio. It is simply the best way to think about it, the best way to think about it as the price of risk. The price of risk. In other words, how much issuers of security must offer in order for you to purchase the risk, in order for you to make you assume the risk. Price of risk. When the price of risk becomes too low, a lot of problems occur in the economy. In other words, risk must be priced right. If the price of risk is extremely high, there will be too little risky investments in the economy. If the price of risk is too low, there will be too much risk in the economy, and that too much risk eventually will overwhelm the capacity of the economy to bear risk. In other words, eventually the law of large numbers will say that when you're taking too many risks in your lives, many of these risks will materialize. Even if 10% of those risks materialize, because the price of risk was too low, the whole economy, everyone was taking so many risks. When 10% materialized, they overwhelmed the capacity or the ability of the economy to cope with risk. In other words, losses are too large for the economy to handle. In other words, losses could become larger than economic growth. In other words, losses overwhelm the economy's ability to grow, and losses move the economy into a recession. Well, once into a recession, a whole new set of processes begin. People and workers' income fall, unemployment rises, other problems occur, suddenly corporations lose profitability, and the vicious cycle begins on the way down. Price of risk.
Sir?
All right.
Risk to variability is the same as risk to volatility?
Variability is exactly the same as volatility. Yes. Variability is a different word for volatility. They mean exactly the same thing, and they're both measurement of risk, measures of risk. Sometimes volatility on Wall Street, and especially on financial media, they don't use the word risk. Risk clearly says to people that something bad could happen. So that's why they never use risk, they use volatility. We are now witnessing an extended period of volatility. Rather than saying, if you guys stay in the market, you can get hurt and you can lose a lot of money. It's just an extended period of volatility. It sounds a lot nicer. Essentially, 99% of the people would not understand what it means. This is exactly the intention. The intention is to confuse the majority of people, of what it really is and really means, or what it implies for their own questions.
A lot of professionals are recommending buying stocks now.
Yeah, of course. Now, okay, a lot of professionals recommend buying stocks now. Here's the problem. If you check last year, a lot of professionals will recommend buy stocks last year. And they recommended buy stocks 2 years ago, and 3 years ago, and 4 years ago, and 5 years ago, and 60 years ago, and 70 years ago. 200 years ago, the professionals were recommending to buy stocks. Professionals always recommend to buy stocks, no matter how good and no matter how bad. They always have a good reason for you to buy stock. That's because professionals sell stock. Well, of course, they get the commission for it.
It doesn't make sense that you buy stocks now because of the credit crunch and the crunch.
Yeah, okay, that's what we're trying to learn here. At any point in time, professionals will advise you to buy stock. The reason is they don't sell anything else. They don't produce oil and don't sell it. They don't produce gold and they don't sell it. They don't produce wheat and they don't sell it. What they do they are Wall Street salesmen. You have to understand, it is called advisor and it is called professional. They're not advisors and they're not professional. Their true, genuine job is salesmanship. You have to understand, what is Wall Street's job? Wall Street's job is selling securities. Well, the first part is manufacture. It creates the stock. That's what the investment bank does. The investment bank issues stock, right, on the primary market. They try to sell the stock on the primary market. So the investment bank, the first thing it does is manufactures it, and then its job is to sell. Then Wall Street does, like Wall Street brokerages, Merrill Lynch would have been one of those, would then try to resell stocks. It works exactly like houses. You have an army of real estate brokers, and their job is to keep selling more houses, because on every sale they get a percentage we call commission.
But when you look at the bigger picture,
yeah, what's the bigger picture?
The macroeconomics of the current economy.
Okay.
Should we buy stocks now or not? Does it make sense?
Okay, again, it depends on the type of stocks. For example, should we buy stocks where? In Japan, or in Bulgaria, in America, or Saudi Arabia? You have different markets. Sometimes markets are what's called off-swing. During the 1990s, American market was skyrocketing all the way up, roaring. The Japanese market was slowly but steadily falling and falling and falling and falling. So, should we buy stocks in the 90s? The answer is yes in the United States and no, not in Japan. So, the answer to a question is depending on where the stocks are. That's number one. Number two, depends what the stocks are producing. If you're expecting, a global recession or a global slowdown, buying stocks of luxury car makers anywhere in the world is a bad choice. Now, if you're expecting oil prices to rise, buying oil companies will be a fairly good choice. Again, you can't just say, is it good or is it bad? Well, it may be good for some US companies like oil and gas service companies due to expectations of overall difficulties in the United States, energy issues that the US has. Well, what will be good for Saudi Arabia? Maybe real estate stocks, maybe construction companies. Okay. Now we get into that thing between macro investment analysis and micro investment analysis, and we call this sectoral analysis or industry analysis. So once you're figuring out what's the macro picture, the next thing to do is to figure out what is the sector or the industry. So which industries will usually outperform in the current environment? You watch the industries, you see maybe car making won't be a great thing to do, to invest in. Maybe other industries will. In other words, if you're expecting the global economy to fall into recession, maybe you should be buying defensive stocks. Defensive means that those industries outperform in bad times. The opposite of defensive is cyclical, but we'll be coming with this next time. All right, good enough. Income analysis.